So, Andy, thank you so much for taking the time to come on the show. This is not our first conversation, but it's going to be our first conversation that we share publicly. Before jumping right into the episode, maybe tell the audience a bit about yourself and your investing background.
Sure. Great to be here, Leandro. I'm a huge fan, so always a little tickled to be, kind of in the hot seat here. I am a self-directed investor. I spent 10 years on the buy side in a variety of roles, kind of back office to front office journey. Um, the majority of those 10 years was playing around with stocks as well as a lot of other asset classes. So I kind of say I'm dangerous enough with other asset classes, but stocks is really what I enjoyed most, and kind of in my post buy side world, what I continue to spend a lot of my personal time on. So now it's just me, my family's money, and maybe an hour a day, not strictly 60 minutes a day, but maybe over a week's time, I'm spending 5 to 10 hours a week researching stocks and managing our investments. And I think I've been doing this self-directed investing for 7 years or so. So there was a little bit of overlap when I really started kind of at the end of my buy side career, thinking a lot more carefully about what my PA looked like, and now it's just my PA. So I'm active on Twitter. I don't do this professionally anymore. I may someday, but maybe not. I quite like being a personal investor compared to a lot of what I hear from folks on the buy side, and certainly what I remember myself being in those roles.
What do you think? What did you take from the buy side? Like what lessons are you applying now that you're a individual investor? You maybe don't have the constraints of the buy side, but surely you took some lessons from it.
Yeah, I mean, so many. One I think about a lot, and the fancy words folks use to describe this is the institutional imperative, and that can refer to a lot of things. But one thing I think about it in regards to is the level of research that goes into a name, and then once you start learning a bit about behavioral economics, the biases that can come along with it. So let's just say if you work at a 2 and 20 shop, a hedge fund, or an expensive long only shop that might charge 1% or whatever, what are you going to do with those management fees? You're going to research the heck out of a name. You're going to know it better than anyone else. And that's fine, maybe, but it doesn't necessarily correlate with returns. And I think there's a pretty big difference between the two, right? Like having a super in-depth knowledge of prior financials versus just having, and I think, Leandro, we're going to end up here, like having a really strong picture in your head of just like what the company is at like a deep level, and what you think it might do in the future based on that. And kind of the latter, how I just described it, doesn't really play well in an institutional setting. You can't show up to a meeting in a suit and just say like, trust me, I've got a good feeling about this. But you definitely can do that with your own money, for better or worse. And the returns that follow, are kind of like equally attractive to those that are available to the institutional investors. So it's not to say I don't research names that I own. I definitely do, but there's no imperative. There's no like huge trove that I need to produce, for my PM, who's going to put it in front of the CIO, who's going to put it in front of the sales guy, who's going to put it in front of the prospective LPs. So I think about that a lot. Another thing I think about just when you're on the buy side, the analyst PM relationship, the PM, kind of has a hole, and you need to fill it with a round peg, proverbially speaking. I don't have that problem. I am the analyst and the PM. And so I research what I think will, most likely end up in my portfolio, and most likely, give me an opportunity to own it for a long time and, of course, generate good returns. So that, kind of those two lack of friction stick out for me from, kind of having been an analyst on the buy side to, now just being a solo investor.
Mm-hmm. It kind of reminds me of when companies are investing into R&D, into research and development, and some will say, hey, we're spending a lot, but that's actually not probably a driver of, spending a lot in R&D is not the same as spending well on R&D. And I think some companies seem to have a budget and they just allocate it regardless of what they're getting out of it. And this seems like a similar situation. So when we were talking over these past few weeks about the topic to focus the episode on, we thought it would be a good idea, and I think that this ties to your point of going back to the purest form of investing, right? To the essence of investing. So no matter what a thesis is, what the qualitatives are, what the numbers are, the outcome of any investment is going to depend on three variables. One is going to be the reinvestment rate of that company, the returns that they are achieving on that reinvested funds, and then obviously your starting valuation. So you've done great work in these variables, right? And as you said there, in maybe showing them in a simple way so that you can really understand what's driving returns. So let's start with the reinvestment rate. I think this one is pretty straightforward, right? It's the money that the company is reinvesting into the business. But maybe you could talk about what are the most important components that you look at when calculating the reinvestment rate. Because, I mean, there are tens of formulas out there, but I don't think a lot of people have stopped to think about what drives these formulas or why those formulas are the way they are.
Yeah, this is a good place to start because it's pretty fundamental. Leandro, you asked me to kind of come with some examples, and so I did. So I think a really interesting one, I think it's going to be helpful for us to just talk about specific names here. So CME, the Chicago Mercantile Exchange, it's one of the largest publicly traded financial exchanges, actually, regardless. And I just pulled up my sheet here. I might share it in a second. They reinvest something on the order of like 10 to 20% of their earnings. So very low. So this is a fantastic business by many measures. Certainly like past returns, returns on investment per se, but just knowing the fact that they can only reinvest. And I think it's crucial in this case to acknowledge that they can only invest other than acquisitions, which they've done. This includes a huge acquisition from 2018 of a kind of a tuck-in, bigger than a tuck-in. They have very limited reinvestment opportunities. And so it immediately tells the prospective investor or the owner of the business that their returns are not going to be generated from reinvesting earnings. In this case, they're going to be generated by earnings growth that does not require reinvestment, as well as significant returns of capital, which CME, they pay out healthy dividends. Off the top of my head, it might be yielding 5% right now. So you're getting that 5% dividend, you're getting earnings growth, which probably something on the order of, call it mid-single digits, maybe even more than that over the long term. And boom, there's like a 10% projected return that, I don't feel too uncomfortable throwing out there as a guess for what, someone who owns CME might earn over the next few years. 10%, a little bit more, a little bit less.
When looking at these two variables, right, reinvestment rate and returns, I mean, you can get high earnings growth, as you said here. There are several ways, right? You can have a low reinvestment rate, but have crazy returns on that reinvested capital. Then you can have very high reinvestment rate, but not so good returns. How do you balance these variables? Do you prefer one scenario over the other, or you're quite neutral?
No, I'm not neutral. And it's funny you asked me about the high reinvestment rate, low return. Something I'd mentioned to you, Leandro, is I don't like speaking negatively about companies. But in this case, I actually can't even think of an example because, maybe just to take a step back, like where am I aiming my, my search when I look for these businesses? I'm looking for businesses that I suspect will have high returns and high reinvestment rate. So, that's the answer to your question where, ideally, you want a company that can invest, call it 100% of their earnings into high returning opportunities. So, the classic examples would be like serial acquirers that take all their earnings and just buy more and more businesses, with those excess earnings, something on the order of 70, 80, 90, 100% of their earnings are just reinvested in businesses. And you'd like to see those reinvestments return 20%, would be phenomenal. So that's ideal. And there's a handful of those out there. Of course, the counterbalance would be reinvestment runway and valuation primarily. I guess also, there's more considerations, but just on a basic level, how long can they keep doing it? And, and just how much you trust the efficacy of that program, that investment strategy, if you will.
And what do you include in the reinvestment rate? Because I've seen many people include a lot of things. I've always had doubts, right? Because if you take, for example, say a software business, right? A lot of the investment is taking place through the P&L rather than the cash flow statement. So then you could take the money that's spent on R&D that's not considered, let's say, maintenance R&D as reinvestment. But at the same time, it's super tough to know what's actually being reinvested if you don't have visibility. I mean, some companies can capitalize R&D costs, but that's not the norm. So then you have these software companies that seem super capital light, but at the end are reinvesting significant sums to the P&L. So what do you include in the reinvestment rate, and how do you treat this kind of scenarios where reinvestment might shift from between the financial statements?
Yeah, that's a really great question. And so the format that I think about this through is incremental returns over incremental investments. And it captures primarily numbers from two financial statements, the P&L and the cash flow statement. I'll tell you how. So incremental returns, I toggle, when I show it on Twitter, I always show it as incremental cash from operations, X working capital, which I think is a pretty good measure of like cash earnings of a business, before any reinvestment needs. Another way, so I've told people many times that I took this from Michael Malbison, who's clearly one of the top investment theorists of our time, and he suggests doing something different. He suggests thinking about it, earnings that is, in terms of incremental EBITDA times a tax rate. And so kind of the big difference there is the I and the T, where mine are after interest and after taxes. He prefers to go a little higher up the income statement for comparability across a broad range of companies. But actually, the point that I'm going to make applies to both, which is that by looking at incremental earnings, either at the CFO level or a net income level or a NOPAT, which is what he calls EBITDA times a tax rate, you capture investments made through the P&L implicitly, not explicitly, meaning, so like Leandro, you had mentioned R&D expensed, or of course like sales and marketing as expense through the P&L. That'll be reflected as a reduction in earnings, right? You end up with less cash from operations to the extent your P&L is burdened by whatever it's burdened by, R&D, sales, whatever it is. And so I think folks, have asked me this a few times, and it might be nice to show it. And there are some super sharp software investors that are going to think about those lines much more explicitly. I don't spend much time with software other than a few like vertical market software companies. But then, so that's the one question you asked me about in terms of like, how do I reflect investments from the P&L? It's reflected in a lack of earnings. It burdens, the incremental earnings piece. But then beneath that, I just try to look at the cash flow statement where the rest of the investments are going to be made. And this would make a lot more sense in the context of like an industrials business. A classic 20th century industrials business is going to spend money on PP&E to maintain the manufacturing facilities required to produce whatever the widgets they're producing are. Of course, acquisitions are also on the cash flow statement, and that's just like money out the door, easy enough. And then I've separated out working capital, and the primary reason why I did this was I follow a handful of distributors where working capital is really an investment, where they kind of constantly have to spend money to maintain an inventory level to service their customers. And I really like having a standardized format. And so for like a lot of businesses, working capital isn't a big deal. Like some e-commerce businesses, it can be a benefit. Same for a software business, it can be a benefit. I just have it in there. So I'm always thinking about, from my perspective, CFO X working capital, and then I reflect working capital as an investment, whereas sometimes it can be a benefit, but regardless. And then I show the rest of the items from the cash flow statement, CapEx and acquisitions. And so I end up with incremental earnings over incremental investments lagged by a year, figuring like you put something in the ground now in terms of a factory, it'll start producing widgets next year. So you have that year lag.
So you call this metric, right? The cash and cash returns. When you compare it, a lot of people use ROIC, return on capital employed. I mean, there are tens of return metrics that people look at. Some might be more, let's say, more adequate for a certain business. Some might be more adequate for other business. what would you say? Why do you prefer to use cash on cash returns than any of these metrics? Why do you feel more comfortable that this is really giving you the picture of how of the returns that the business is achieving?
Yeah, I do really like this a lot better, and it's quite similar to the metrics you referenced. But what I like about mine is it's giving you a picture of of the machine in motion. And by what what I mean by that is I think one of the CFA level 1 textbooks basically says, as they're telling you how to think about free cash flow, every business is just like a money machine, and it, just totally dependent on how much money will spit out. You can think about it in that way. And so it's kind of that essence. And I actually can't find this diagram. I've thrown all these books out, save for a few of them, but I'm trying to capture that essence, and not for like vanity purpose, but I think it's like truly a super efficient and like elucidating way to look at a business to try to understand what the return drivers might be, to see both of these, the numerator and the denominator of this fraction that I've created in motion, right? We're particularly like, and I'll see if I can say this clearly, but like a business like CME or like Nasdaq, where I spent a lot of time thinking about these businesses, they have massive asset bases, and so a lot of times you'll see a poor return on an ROA or an ROIC, but it doesn't give you a picture, in terms of how the money is flowing through the machine. It's not really, I think, as helpful for the prospective investor or the investor. Whereas when you see it in motion, you kind of get a sense of like, oh, this is a heavy reinvestment business, or no, there's actually low reinvestment business, even on top of a historically big asset base. Money's coming back out the door to me in the form of dividends. So, this just kind of helps me. And I try to tell people, this is like my first look at a business. And I told you, Leandro, for businesses I actually own, I don't just like look at this, little output. I end up going really deep and thinking about it in much more thorough ways. But this is like a fun way. Someone will mention a business on a podcast, like, oh, what does that money machine look like? And then and then I look at it, and then like, 1 out of every 10, 1 out of every 20, I'll be like, oh, this is actually worth me pursuing further. And then I'll kind of start peeling into it.
Well, I actually think it's a good way to start, right? Because you can get a feel of how the variables that actually are going to result in the earnings growth are moving. So then you know more or less where to look, or maybe you spot something worrying, right? I mean, hey, reinvestment has been super low. What's the reinvestment opportunity here? Why have returns been so high over such period and lower over next period? So I think it's a great way to start. And something we've talked about is this concept of, let's say, per share returns, right? Because I remember I was talking to you about cash on cash returns, and I was looking at a business that had, let's say, SBC, stock-based compensation, had been increasing. So then obviously if you use cash flow from operations, then cash flow from operation is going to be growing just due to the fact that it's SBC is a higher contributor than in years past. So then obviously that can inflate your returns because you're not taking into account SBC on the invested capital denominator. So how do you look at these kinds of cases where maybe the returns are great, but you've seen sort of dilution? So then those returns are not accruing to the investors as they were in the past.
Yeah, so I'm a strong proponent of how the cash from operations adjusts out stock-based compensation, and I'd much rather think about that in terms of dilution going forward. And then to your question, in the same way, I would discount any cash on cash returns against the dilution used to achieve that. So if you have a 15% cash on cash return looking backwards, but maybe shares were diluted 20% along the way, I think you take the cash on cash return over like 1 minus the dilution, or you'd somehow reduce the cash on cash return commensurate with the amount of dilution used to achieve it. And that's, like, I think pretty reasonable, like pretty straightforward in a way. But yeah, I know me and you have talked about, like, whether dilution and SBC, an SBC or whatever. I always prefer to think about it in terms of a percentage and how it might affect future returns, as opposed to the accounting conventions don't really do justice to how to SBC, and it ends up being very wonky and whatnot.
Mhm.
Whereas the actual share count, just like on a, if you're talking about FCF PS, the PS is quite clear. It's just the amount of shares. And obviously you think more about it. How do those shares get granted? You look at the proxy, you look at what's driving that, those share issuances for sure. But that's my preference. And I do think it's like a really important addition to this framework to consider the per share effect. And for some companies it's nil, and for other companies it's very significant, obviously.
I think it's a great point that you touch on there, because a lot of people tend to view higher SBC is the same as more dilution, but actually there's more to SBC than just the options that are given to employees, right? I mean, volatility can play a role in SBC being higher. So that's actually something that I have to consider when adjusting, because I ended up adjusting for SBC, which obviously it's not game changing, right? It's going to lower a bit the returns the same way that it will lower them if I take into account dilution, but maybe it's not as precise as including the dilution. So one thing that I wanted to ask you, right? Because now you've got, so if we go through the three variables that are the essence of investing, we've talked about the reinvestment rate, we've talked about returns. So now let's talk about the final one. Let's talk about valuation. How do you approach valuation? And another thing that I wanted to ask you, maybe this one before the evaluation question, is have you found a strong correlation between the cash on cash returns and the returns that the companies have delivered going forward? So do you think it's a variable with high predictive power? Maybe you've never looked into it, but just curious.
Yeah, so this is a tough one, obviously. I think something I've kind of come to appreciate in my kind of this middle phase of my investing journey, let's say, is I respect the heck out of valuations, in terms of it's the combined, kind of the collective wisdom of the markets, let's say. And I generally approach them as assuming that they're more right than not. My initial inclination is that, hey, this is kind of telling you the market, thinks about a business one way or another. And, also another thought is that, great businesses can support great valuations. That's somewhat obvious, but I think important to say out loud. And, I think another, way you can think about them is they're like odds where, keep in mind the market's very smart. Often a valuation on a company is correct. Not always, certainly not always, but like generally speaking, if you turn over 10 rocks, 8 of them are going to be probably, not so incorrect in terms of, where the market values it and what future return drivers will come from that. I don't necessarily expect huge valuation changes, but they can be sources of big returns. If you do, strongly feel like one is wrong and it re-rates in your favor, that's going to do well. It's often not a big part of my, my thesis. It's something I picked up from real estate investing. Whenever you talk to a real estate investor, they always talk about, assumptions of no cap rate, compression, right? That's their way of saying that they're not expecting the multiple to increase. And I think that's just like a really reasonable way to forecast, where, generally speaking, you don't want to assume the market is going to pick up on what your thesis is. Rather, you want the returns that you're forecasting to come from earnings growth. That said, I like multiple expansion in my favor, and I've certainly benefited from it in ways. But when you're underwriting a stock, I don't think, often you should count on that. It goes back to this value and growth thing, where a lot of value investors, the thesis was this is trading too cheap, and they buy something, 50 cents on the dollar, it re-rates to 80 cents on the dollar, you sell as it approaches fair value, you rinse and repeat. And it's a really tough strategy, I think, because it kind of by definition requires a lot of turnover. So both from the idea generation standpoint, like trading, taxes, etc. Whereas if you get much more into this like quality and growth camp, you're not necessarily as quick to sell, and you're more comfortable owning stuff with higher multiples if you think the business underneath it, can support it. maybe that's bull market talk or whatnot, but that second camp is much more where I've gravitated, having started my career at a deep value hedge fund, and kind of played in both waters. And there's lots of different ways to make money. I think it's a personal choice, but I am comfortable with high valuations with businesses attached to them that justify it for sure.
I think it goes back to the point of when you're buying a great business, then time is by your side. And when you're buying a bad business, then time is against you. And you basically have to be very right on the timing before you basically get destroyed by the market in due time. So you've talked there about selling. So let's talk about selling. I mean, you purchase a stock, the stock runs up significantly. How do you approach selling? When do you decide to sell? I think this is one of the most difficult topics for any investor, right? Because you can say, okay, the company here, you buy a great company, the company here feels overvalued, so I might sell. But then at the end of the day, you don't know how much time the company is going to remain in that multiple. You don't know if it's going to grow into its valuation. Great companies have a lot of optionality. Maybe they come up with a new business segment that you were never expecting. I mean, if you look at the best compounders of all time, a lot of them seem pretty expensive during certain times of their history, and they would have done quite well, right? Because these companies managed to grow above what everyone was expecting. So how do you approach selling? I don't know if you have a maybe sort of checklist to decide if you want to sell, or you're doing more based on intuition.
Yeah, it's really hard. There's no checklist. I think about some of the stuff I've sold, and I actually just this morning reread this summary of a book by Lev Freeman Shore. That's a portfolio management book that Gavin Baker has written about. That is one of the very few portfolio management theories that I've tried to adopt. And let me try to start from a different angle. So the goal is not to sell. Generally speaking, if you think about how to make a lot of money in stocks, it's from not selling. And so I've taken that to heart in terms of what businesses I'm looking at initially is like, is this a business I would hope to be able to own from a qualitative perspective? Am I interested in it? Am I excited to listen to the quarter podcast, 4 times a year, et cetera? Is it something I'm comfortable with? And using that as a filter to hopefully end up with businesses that I don't sell. And that's worked out pretty well the past few years. There's a handful of businesses that I've owned for a long time that I don't really think about selling, even as valuations sometimes can get silly. Sometimes I've sold like one, and I've talked about this on Twitter a lot, is Old Dominion Freight Line. This is like kind of like widely considered a good business. And I don't think that was wrong kind of in the 2010s. They were basically a classic example of what you and I were talking about, where they were reinvesting about 100% of their earnings at a nice clip, like call it, I don't know, 30, 40% returns. They were basically buying warehouses at the corner of 2 interstates. And that's their business. They created this physical network where their trucks traveled between and transported goods. And on top of that, they would add doors. So they might buy a building with like 50 doors. And then, 3 or 4 years later, as volume necessitates, they would add more and more doors. So the returns were phenomenal. The stock reflected so much. The excellent operators, clearly there's an award in their industry, for like the best operator, and they won it like 13 years in a row. It's hilarious. But if you actually look at this framework that I use, cash on cash returns, they stopped reinvesting. They like literally ran out of investment. And I was like, oh, that's my thesis. And the thesis is broken. So I sold. And, no victory laps here, because I think there was a lot of macro luck in my favor in terms of the trucking market can be cyclical. And I think I probably sold at a cyclical top, combined with ODFL losing this reinvestment opportunity or it greatly diminishing. They flipped to buying back shares at a pretty high multiple. And so like, as expected, the stock has just kind of gone sideways. So that was a good sale, and kind of relates back to what we were talking about. I have a lot of not good sales, mostly where I just like lose, like kind of just classically like lose confidence, get shaken out on bad earnings. One that was interesting, I actually haven't followed up exactly on how this has happened, but like MSCI, this is, again, an amazing business, and maybe like similar to ODFL, was an amazing business for a period of time. And They made a few acquisitions. I think they spent like, maybe $1 billion in total, or maybe $1 billion on 2 acquisitions at just extremely high multiples, just like headline multiples. And one might argue that those get, much lower as revenue synergies or whatnot can be applied. But it just kind of felt like they lost the plot. And, even in the scheme of things, it wasn't a huge impact to their like kind of overall cash on cash returns, but it was just like, oh, you're going to go do silly stuff, with your earnings. I'm not super enthused to be a shareholder anymore. I don't exactly know how MSCI has done since those, what I described as silly acquisitions. I actually sold SPGI when they did the huge share issuance to merge with IHS, and I think that was quite a mistake. Kind of my bat signal went off, like, oh, huge share issuance, big merger, like base rates are low, let's sell. So I don't necessarily think my track record on selling has been good. But going back to how I started, I really try to look at businesses that I hope I won't be pressured into selling, either for good or bad reasons, let's say. And that's really helped me narrow like what I look at and what I buy and what I own, from, some of the tough episodes I've had in terms of good and bad sales. And I think a lot of investors can relate to that. Many sales aren't good sales. Generally speaking, the stock market goes up over time.
I think what you said there is actually an underappreciated thing, and the fact that you look for companies that you enjoy researching. I feel that many people basically will research an opportunity even if they hate what they're reading, or they hate the sector, they don't enjoy it. And I think there's so many companies, publicly traded companies, that you don't need to do that. I mean, there are companies there that you can enjoy their business models. You can learn a lot while researching them, even if you don't buy them, and make the process much more enjoyable. I mean, I can't imagine myself having to go through 10, 15 earnings calls and not enjoying any of them, because I basically don't like the business, even if I think it's a good opportunity. So we've talked about the 3 drivers, but obviously investing is much more complex than just looking at these variables. Well, maybe the valuation is quite tough, but the first 2 are sort of straightforward. But investing is about the future, right? So you need to think about how those variables are going to evolve over time. What are the key traits you look for in a company to try to maximize both the reinvestment rate and the return? So to feel comfortable that those variables are going to trend in the right direction.
Yeah, that's a really good question, and I think this is a nuanced like take that I've had to understand. What's happening for myself is that I've had a lot of success the past few years with this pattern. A+ managers, like A+ operators, and obviously compelling return opportunities with less than amazing businesses in between. I think there was a fantastic appreciation for like high quality businesses, particularly like leading up to COVID, like an MSCI, for example. And I don't know if it's just because I live in a bubble, but it feels like that theme has been played out a lot compared to the opportunity that existed a number of years ago. And, and I agree, like generally speaking, like I don't see a lot of my portfolio in these classic compounder, competitive advantage names. Rather, what I found that really works well for me, and I talk about this a lot on Twitter, as do other folks, is trying to find managers that I think are exceptional, and then marrying that with like what I describe as like just like fat pitches, right? Like I think Buffett probably coined that term or whatnot. And the not quite great businesses in between, it's actually beneficial in a way because they're getting graded kind of on a relative basis, right? Like they're kind of playing, when their competition is weaker. For example, like I own a handful of serial acquirers. It's quite beneficial if you have a super adept management team, an undemanding valuation, and the businesses that they operate are kind of sleepy businesses, such that they can acquire other businesses. Like that's kind of a wonderful marriage in a way. Whereas, hyper competitive, very well run businesses, are going to trade much more expensively or whatnot. So anyway, so that's how I think about it, where I'm quite less concerned about the competitive advantage of a business per se, and much more concerned with the who's running it and kind of why they're doing what they're doing. And low valuations, have helped for sure.
I think that if two names come to mind when hearing you say this, one is Constellation Software, right? I mean, Constellation Software is a collection of okay businesses in niche markets, strong competitive position, but it's not the best business. It's not they're not buying businesses that as standalone businesses would be getting super high multiples in public markets, right? But you have a great management team that knows how to operate in those businesses, and they've managed to roll up part of the industry. Another name that comes to mind, and I think you discussed it not long ago on Twitter, is Judges Scientific. Much smaller than Constellation, right? But it's more or less the same concept, not software, but they are buying good businesses in niches and they are rolling them up. And you have a great management team that's allocating the capital. And I feel that these businesses, the serial acquirers, to your point, they tend to get quite, let's say, highest multiples, but a lot of these multiples tend to be very misleading. So I think everyone has heard the classic argument for Constellation that the PE is too high, but obviously these companies are expensing a lot of amortization of intangibles because they are acquiring companies, and that's not really the economic truth that's going under the hood, because some intangibles don't need to be replaced and therefore it's not a real expense. So I think it's tough for the market to value serial acquirers well once you find a good serial acquirer, because thinking that reinvestment can go on for so long, it's, in my opinion, very tough to grasp for the market. I mean, who would have said that a company like Constellation, imagine 15 years ago, we get a time capsule and you say, hey, it's the year 2024 and Constellation is growing 20% revenues. And you're like, no way. I mean, that cannot be. And here they are, right? And I think those kinds of businesses tend to get underappreciated. But going back to management, this is one of the most subjective topics there are in investing, probably. How do you assess the quality of a management team?
Yeah, I think one of the most obvious things you can do is just look at the track record. So like Judges, for example, I think Chickarell, if I'm saying his name the right way, he's been running this business for about 20 years, really similar to Mark Leonard, other than in kind of the lack of prodigiousness. But anyways, for Chickarell, he's basically just been doing the same thing for 20 years. And so that's a strong tell. He doesn't write investor letters per se. I think there may be some at the beginning of the annual reports where they, more European style, just kind of report out on the business to the shareholders, which American companies don't do in the same way. But just the track record is a really strong tell. The amount of share ownership is a really strong tell. I consider these, particularly the share ownership one, it's like naive. You just look at a number and you say, how much do you own? And it leaves a lot to be desired per se in terms of other insights, but those are really strong indications. Investor letters and the communication from these managers, if they participate in conferences, I think that's the other, the other insight, area where you can gain insights, where you just kind of listen to them and you think in your head, do I believe this guy? Does he seem like he's thinking about it in a smart way? I'm not going to say anything new here, but, a lot of managers, CEOs don't think about capital allocation in the same way you and I do. And it doesn't necessarily mean it's bad. Even like Shift4 is a company I liked a lot before their CEO got tapped to lead NASA. They didn't talk about their acquisitions in a way that I thought was kind of doing justice to the returns they were generating from them. And that was okay by me. I don't think they, I kind of know for a fact they didn't have the same background that I have or whatever, but it was the case that they were being successful with their acquisition program. And I think they will continue to be. But then there are other managers where you think, like, you hear them talk about it and you're like, I don't actually think you're gonna like generate value for shareholders from whatever you're talking about. So just like listening, I am like so grateful for this Quarter app, because I can, I listen to it all the time. I'm driving my kids to daycare and like they're listening to Quarter with me, and we're listening to the conferences and whatever. And just kind of like accumulating time with these managers in the form of hearing them at all their reports and all their conference appearances or whatever. It'll help you form a picture in your head of who it actually is, in charge of these money machines, if you want to think about the businesses like that.
I remember David Sicurel. He was on a podcast and he said something that it's actually quite relevant for the conversation we had today about reinvestment rate and return. He got asked, okay, so you basically have more opportunities, right? So you could have lowered your hurdle rate and you could have deployed more capital through these years. And he basically said, well, obviously we could have deployed more capital, and we would probably be in the FTSE 100 because we would be bigger, but we've compounded at 30% plus over 20 years, right? And that's because our hurdle rates were kept where we wanted to keep them. So it's crazy when it's actually a revelation, because as you said, one would think that a CEO or a CFO first knows how to allocate capital. And second, for a CFO, one would think that they know how much their company is worth. And it's quite surprising when you find out that they actually don't know how much their company is worth. I mean, a good CFO could be the best insider trader. I mean, they could basically buy when they have much more data than investors, and it's crazy how many times they actually don't understand how much their company is worth. And to your point, when you listen to many of these good capital allocators, when you hear someone speak that's maybe not as good, I think you pick it up quite fast, right? Just based on the way they're talking, what they are focusing on. And I'm going to talk here about a company that I recently trimmed my position significantly, which is Intuit. So Intuit made two very large acquisitions,
Yep.
Credit Karma and MailChimp, both through periods where multiples were inflated. One could argue that they also paid with stock, which was also inflated, so that sort of compensates. But they were evidently, especially MailChimp, seemed like a terrible acquisition. And at the same time, that Intuit's business, I believe it's great, and they're excellent operators, but they basically spent 20 billion of shareholders' money into acquisitions. So it's tough to balance between, okay, these guys are incredible operators, their core business is being run exceptionally well, but then you run the risk that they're going to go to the market and do this and basically blow a lot of shareholder money. So then you're torn between, okay, should I sell this great business, which is irreplaceable in many cases? Like it would be tough for someone to eat into their mode, but at the same time, should I give them my money when there are people that know how to allocate capital better? So it's always a trade-off. I don't know how many companies you tend to own and how do you balance between. I think one underappreciated thing about investing is position sizing, right? You might have 20 great businesses or 15 great businesses in your portfolio, but if you're weighted towards those that are not going to have the best performance, then even if you owned the right companies, you didn't own them in the right size.
Yeah, it's a really tough question. What I've ended up doing is 5% as a default position size, and allowing myself to go up to 10%, and like no starter positions, no tracking positions. One of my friends a few years ago was like, if you can't own something at a 5% weight, like you shouldn't be owning it. And I agree with that. I think you could argue the other way. I know folks that keep a little stable of little trackers to help them focus. Right now, I think I have 15 names in my portfolio, and that seems like the right amount for diversification, and just knowing what I own. Everything in there I should be able to speak to like pretty credibly. I always imagine, if my mom asked me what this business does and what do I think about it, like, having an answer on the ready. And yeah, that seems to be my coverage, but I've not, cut a lot of winners. And so my biggest position is a 25% position. And then I have a few other like kind of 10, 15% positions. So the portfolio is quite skewed towards those, which I mostly like. I think on the path to, to kind of glory, if you will, this is what it looks like, kind of having uncomfortably big positions. But, it's uncomfortable. People are pinging me my DMs. Andy, are you trimming? Are you trimming? And I'm like, no, not yet. Still not trimming. But yeah, and so that's where I'm at. I think it's a good number. I think kind of less than 15, you're getting pretty concentrated. I think more than that, you're stretching your kind of your talents as an analyst. And by you, I mean me. I can't speak for anybody else, but that's how I've structured the portfolio, and it seems to work fine.
I've also kind of against getting tracker positions, because I feel that if I get a tracker position, then what I'm going to end up doing is probably force my research and maybe skip through certain things. And I mean, there are hundreds of opportunities in the market, right? Or companies. You don't need basically to own them all, which I also think is something that there's a lot of FOMO, right? Of fear of missing out. When you see people, there's a company that's done great, and everyone is like, damn, I should have owned that. But I think there are tens or hundreds of portfolio combinations that are going to do just well over the long term. So it's much better to just focus on your portfolio and not look at what others are doing. Well, you can look, but not over obsess with what others are doing. So Andy, I think the conversation's been great. We basically talked about all the building blocks of investing, and I wanted to end the conversation asking you about a book, can be investing or non-investing related, that you feel listeners must read if they have not done yet.
Yeah, it's interesting. I had one book and then I had another. So I'm going to throw them out there. One's going to be totally from left field. When I was in high school, my dad strongly suggested I read Siddhartha by Hermann Hesse. And probably no one mentions this, but to me, the goal, why he told me to read it, I think what a lot of folks get out of Siddhartha is just like your personal journey. It's something that you and I talked about earlier on, that I think to the extent you can make your investing reflect who you are and what you're interested in and what you think about things, I think you'll end up, more giving yourself more opportunity to be successful. And that's really what I've tried to embody in this kind of like phase of my investing career, where I'm just doing it for myself and just trying to hew as closely as I can to what's interesting to me, what I think I can make work. And I think it's a wonderful book, and I've reread it, as an adult. But then the one I always throw out, like much more vanilla, is The Outsiders. And it's just a fantastic collection of case studies of exceptional CEOs. So, these exist in the public markets. They exist in my portfolio. They're cut from a very different cloth than your standard kind of bureaucratic, manager CEO. And basically what the book shows you is that through really extreme, both capital allocation decisions and operating rhythms, you can generate extremely extraordinary results. I always like to caveat that, there's a natural pushback that not every CEO who seems different or makes extremely unique capital allocations will generate for their shareholders exceptional returns. Of course, I'm not saying, this is not like an index of outsiders that you can invest in, but I thought it's a really helpful, light to shine on this kind of unique corner of the markets. And if you end up, kind of finding one of those types of CEOs, the path to fantastic returns is kind of an easy one. Sidecar, who I think you are friends with on Twitter too, it's just as simple as pressing a button once you've done the work and kind of letting it go. So I've been lucky a few times in finding CEOs like that, you know, that have been somewhat life-changing for me and kind of the returns I've been able to generate, you know, through those businesses. So I think if you haven't read that book, The Outsiders, it's well worth, you know, a weekend or however long it takes you to read that book.
I think it's crazy how some people buy a stock, and this ties with Sidecar's comment. How many people buy a stock and start thinking about what the market will do, when in reality is you buy a stock and then you start thinking, or you don't even have to think, because you've given your money to someone who knows what to do with your money. Evidently, you're buying in the secondary market, so you're not giving directly your money, but you're trusting someone to allocate those funds appropriately, right? And that's going to be a driver of long-term returns, and not what the market does over the next 12 months. So thank you very much, Andy, for coming. I think it's been great, and the listeners will appreciate this.
Thank you so much for having me. I'm a huge fan of your work, and
I have to say the same.
Great. Thanks so much, Leandro.
Bye-bye.